Navigating uncertainty. The essence of risk-adjusted returns and their paramount importance. In the realm of investment strategy, the concept of risk-adjusted return emerges as a beacon guiding investors through the tumultuous seas of uncertainty. This metric represents a nuanced approach to evaluating investment performance by factoring in the level of risk undertaken to achieve a certain level of return. Understanding the essence of risk-adjusted returns and their paramount importance requires unraveling the layers of this complex metric and appreciating its role in fostering a more comprehensive assessment of investment outcomes. Risk-adjusted returns defined. At its core, risk-adjusted return is a measure that assesses the return on an investment in relation to the level of risk associated with that investment. While the raw return on an investment provides a snapshot of its profitability, risk-adjusted returns delve deeper, accounting for the inherent uncertainties and volatilities that accompany different investment opportunities. This metric serves as a vital tool for investors aiming to strike a delicate balance between maximizing returns and managing the inherent risks embedded in their portfolios. The Sharpe ratio, a cornerstone of risk-adjusted returns. One of the most widely used methodologies for calculating risk-adjusted returns is the Sharpe ratio. Conceived by Nobel laureate William F. Sharpe. This ratio evaluates the excess return of an investment, the return above the risk-free rate, relative to its standard deviation, which serves as a measure of its volatility or risk. The formula encapsulates the fundamental tenet that higher returns should be commensurate with higher levels of risk. To illustrate the significance of the Sharpe ratio, consider two investment opportunities. Investment A yields an average annual return of 10%, while Investment B generates an average return of 8%. At first glance, Investment A might appear superior. However, when factoring in the risk, if Investment A exhibits higher volatility, the Sharpe ratio might reveal that Investment B provides a more favorable risk-adjusted return, considering the lower risk associated with its performance. Balancing risk and reward. The importance of risk-adjusted returns lies in their ability to provide a holistic perspective on investment performance. Investors, by nature, seek to maximize returns, but this pursuit is not devoid of risks. An investment that generates impressive returns may also be accompanied by heightened volatility and unpredictability. The concept of risk-adjusted returns prompts investors to ask a crucial question: how much risk am I willing to undertake to achieve a certain level of return? Consider a portfolio manager tasked with constructing an investment portfolio. The manager must assess various assets, each presenting a unique risk-return profile. Without factoring in risk-adjusted returns, the manager may prioritize assets solely based on raw returns, potentially exposing the portfolio to excessive risk. By integrating risk-adjusted metrics like the Sharpe ratio, the manager can make more informed decisions, selecting assets that not only deliver attractive returns but also align with the risk tolerance and objectives of the investor. Volatility and downside protection. Volatility, the inherent variability of asset prices, is a key component of risk-adjusted returns. Investors often grapple with the trade-off between high returns and the potential for significant price swings. Risk-adjusted returns offer a nuanced perspective on this dilemma, allowing investors to discern whether the volatility experienced by an investment is justified by the returns it delivers. Moreover, risk-adjusted returns emphasize the importance of downside protection. While achieving high returns is desirable, safeguarding capital during adverse market conditions is equally crucial. The Sharpe ratio, by incorporating standard deviation, accounts for both upside potential and downside risk. An investment with a high Sharpe ratio not only demonstrates the ability to generate returns but also suggests a prudent management of risk, offering a more resilient performance profile. Long-term sustainability. Investors with a keen eye on long-term sustainability recognize the significance of risk-adjusted returns in preserving and compounding wealth. A strategy that relies solely on chasing high returns without due consideration for risk management may yield short-term gains but could expose portfolios to the pitfalls of market downturns. Risk-adjusted metrics act as a compass, guiding investors towards strategies that aim for consistent returns while navigating the unpredictable terrain of financial markets. Consider a scenario where two investment portfolios deliver identical returns over a given period. However, upon closer examination, Portfolio A achieved these returns with lower volatility and a higher risk-adjusted return, as reflected by its Sharpe ratio. In contrast, Portfolio B, while generating the same raw returns, exhibited higher volatility, signaling a potentially riskier journey. Investors inclined towards sustainability and wealth preservation would find solace in the risk-adjusted metrics, favoring Portfolio A for its ability to achieve comparable returns with a more prudent risk profile. Adapting to investor objectives. Risk-adjusted returns are not one-size-fits-all. Their significance lies in their adaptability to individual investor objectives and risk tolerances. Investors with a conservative approach may prioritize strategies that emphasize capital preservation and lower volatility, even if it means accepting lower raw returns. On the other hand, investors with a higher risk tolerance may be willing to explore more aggressive strategies that seek to maximize returns. Accepting the accompanying volatility as part of the journey. The importance of risk-adjusted returns is underscored when considering the diverse array of investors with varying financial goals, time horizons, and risk appetites. By incorporating risk-adjusted metrics into their decision-making process, investors can align their portfolios with their unique circumstances, ensuring that the pursuit of returns remains harmonized with their broader financial objectives. Conclusion. In the ever-evolving landscape of finance, the concept of risk-adjusted returns emerges as a guiding light, illuminating the path for investors navigating the complexities of risk and reward. By acknowledging the inherent uncertainties woven into the fabric of financial markets, risk-adjusted metrics offer investors a more holistic and nuanced perspective on investment performance. Whether measured through the prism of the Sharpe ratio or other methodologies, risk-adjusted returns stand as a testament to the importance of balancing ambition with prudence, ensuring that investors not only reach for returns but do so with a steadfast awareness of the risks that accompany their financial journey. In the dynamic interplay of risk and reward, risk-adjusted returns serve as a compass, empowering investors to chart a course that aligns with their unique financial aspirations and risk tolerances.